All right, now we're going to see a unique situation where we want to be able to compare the yield's maturity and the yield's call. In this case, a firm's bonds have a maturity of 10 years with a $1,000 face value. Have an 8% semi-annual coupon and are callable in 5 years at $1,050. And they currently sell at a price of $1,100. What are their nominal yields maturity and their nominal yield calls? Now, the easy way forward with this is when we want to do a nominal yield to maturity or a nominal yield to call. Essentially what you'll do is you will first convert the nominal rates that you have, the 8% semi-annual coupon, into their semi-annual rates. And then once we calculate the yields maturity and the yields call, we're going to multiply them by 2 to get back to the nominal yields maturity and the nominal yields call. So using the basic formula, we're going to go for our yield maturity. The yield to maturity formula, of course, requires that we have a coupon payment plus our par value minus our price. All of that is to be divided by time to maturity, and all of this is to be divided by the average of our par and our price. So par plus price divided by 2. This is for our yield to maturity. What we're going to do is we're going to slightly modify this to calculate our yield to call. And so once again, for our yield call, we do have our coupon payment. Instead of direct par, we're going to have our callable. We're not going to have our face value minus our price, but we're going to have our callable par. That's the par plus premium instead of our par value. And so that is going to be callable premium, call premium minus our price, our current price. All of that is to be divided by time. In this case, N is time to call, not time to maturity. And of course, our call premium plus our price averaged divided by 2 over here for our denominator. Now we've got a yield maturity formula, we've got a yield call formula. We're going to go ahead and plug in all of the values that we need over here. For some rough work, we just need to ensure that we have our 8% semi-annual coupon. So that'll give us a 4% coupon rate, which means that we'll have a $40 coupon payment. And how do we get to this $40? We simply take 4% and we multiply it by $1,000 par value to get our coupon payment of $40. And that is about all that we need to convert over here, luckily. So we've got our coupon payment of $40 plus our par value of $1,000 minus our price of $1,100 divided by, we have 10 years to maturity in the case of yield to maturity. All of this is to be divided by 1,000 plus 1,100 divided by 2. We're going to go ahead and plug all of that into our calculator step by step. So 1,000 minus 1,100 is 100. 100 divided by 10 is 10. So 40 minus 10 is going to give us 30 over here in our denominator. Sorry, in our numerator. And of course, 1,000 plus 1,100 is 2,100, and 2,100 divided by 2 is 1,050. So 30 divided by 1,050 will give us 0.0285. And remember that this is our effective yield to maturity. So we want to multiply that by 2 to get our nominal yield to maturity, which gives us a 0.0571. That means we have an effective 2.85% yield to maturity and a nominal 5.71% yield to maturity. Now that we're done with the first part, let's go over to our yield to call. And in our yield to call, we're going to plug in all of our necessary values. So we've got a 40 for our coupon payment. Our call price is $1,050. And of course, our current price is $1,100. The call can be initiated 5 years from today. So let's go ahead and put that in at 5 divided by 1050 plus 1100 divided by 2. We're going to go ahead and plug that in one by one into our calculator. So 1050 minus 1100 will give us 50. 50 divided by 5 will give us 10. And because that is a negative, so we will do 40 minus 10, that's 30. That's our numerator. And now for our denominator. So we got 1050 plus 1100 divided by 2. We get 1075. So 30 divided by 1075, and this will give us 0.0279. And remember that this is effective, so we want to multiply that by 2 to get our nominal yield to call, and that will become 0.0558, or a 5.58% yield to call. Now, in this particular case, what you need to remember is that if your what return should investors expect to earn on these bonds is entirely dependent upon market conditions. And so if interest rates within the market decrease, the company can reissue debt at a lower rate. They will call the bond at 5 years. If however interest rates within the market tend to rise, then the company will not call the bond and the investor will be able to generate their yield to maturity. If you have any questions, please comment below. Don't forget to like and subscribe. Thank you.